Welcome to BWC News. I am Elizabeth. On May 5, the Federal Reserve reportedly announced a 25 basis point increase in interest rates to the current range of 5.00% to 5.25% at a time when a larger crisis may be brewing in the U.S. banking sector. The rate hike is the 10th in the current aggressive rate hike cycle, and some analysts believe this could signal the end of the current round of rate hikes, after which the Fed is expected to pause and compromise with the government sector. However, there are still risks in the market. In its latest interest rate statement, the Fed removed the phrase "future rate hikes" from the last 9 statements and removed the reference to "some additional policy tightening may be appropriate." In addition, they no longer said they expect further rate hikes will be needed, but said they will watch future data to determine whether further rate hikes may be appropriate. This was seen as a clear signal of compromise, with the market recalling the halt in interest rate hikes in 2006. The U.S. banking sector is now likely to face greater risk and uncertainty and the potential for broader market turmoil. In addition, the U.S. debt burden continues to increase, which could put more pressure on the U.S. economy. Recent news suggests that the Fed is seeking a balance between controlling rampant inflation and the risk of a collapse in confidence in the U.S. banking system by signaling a compromise under pressure from the U.S. Treasury Secretary's warning and the soaring cost of the debt burden. Some analysts believe that this means that the Fed used a day to say goodbye to a year, to start with a strong economic recovery, but ended with a crisis. Some analysts predict that if the U.S. Treasury to prevent debt default funds are used up in advance, the United States may consider using gold reserves or minting $1 trillion worth of platinum coins to pay off the debt first, to ensure that the United States remains solvent. However, no evidence has been found to suggest that the U.S. would use gold or platinum coins to repay its debt. Emerging within 3 weeks of the upcoming expiration of the U.S. debt ceiling, Wall Street is increasingly concerned about the prospect of a default, which could weaken the dollar's currency status and the stability of U.S. Treasuries. Treasury Secretary Yellen said again on May 4 that U.S. sanctions imposed on foreign countries such as Iran would eventually jeopardize the dollar's global dominance, and over time it could undermine the dollar and the dominance of U.S. Treasuries. Joseph Abbott, managing director of Barclays, wrote in a research note that repeated U.S. debt ceiling standoffs will sap the credit of the dollar and damage the unparalleled financial firepower the U.S. economy possesses, especially since multiple global geopolitical and fragmented economic factors are now reversing the dollar's supremacy. At this critical moment for the Fed to hear thunder in silence, events may occur that are beyond the energy of the U.S. Treasury and the Fed and that were not anticipated in advance. According to U.S. media, Zero Hedge reported on May 4 that Iran recently seized a U.S. oil tanker in the Strait of Hormuz and that the U.S. Navy deployed a drone to film the entire incident, but did not take more direct action. The U.S. Fifth Fleet also confirmed the news in a subsequent statement, saying the tanker was surrounded by a dozen Iranian speedboats during its journey, forcing the tanker to change direction and head toward Iranian territorial waters. After the incident, the Iranian side also did not shy away from directly taking responsibility for the seizure, saying it received a complaint before taking action, but did not disclose the specifics of the accusation. It is worth mentioning that a week ago, Iran also seized an oil tanker bound for Texas, but the Iranian side said that the U.S. tanker did not comply with the rules first hit the Iranian ship in the first place. After the incident, the U.S. Fifth Fleet condemned Iran for violating international law, and ordered the Iranian side to release the ship, but did not think that Iran did not take the U.S. warning seriously, but also seized another one. Iran did so because the U.S. first confiscated a tanker loaded with Iranian oil, thus taking retaliatory action. According to shipping companies, about 20% of the world's crude oil needs to be transported through the Strait of Hormuz, and judging from Iran's 2 seizures of U.S. tankers, more similar things are expected to happen in the future if the U.S. insists on not releasing the ships. In addition, the 4 defense ministers of Russia, Iran, Turkey, and Syria met in Moscow recently and held positive consultations on the situation in Syria, giving new impetus to the stability of the Middle East and making Iran less worried in the face of the United States. At the same time, Iran and Saudi Arabia will also usher in various aspects of cooperation in the economic and energy fields, which will help offset the long-standing sanctions imposed by the United States on Iran, and will be more confident in the face of the United States. As you can see, as the situation in the Middle East becomes more and more stable, there will be more and more countries that no longer take orders from the United States, or even in danger of getting out. In the beginning, when the United States dominated the Middle East, Iran dared to repeatedly capture US drones and drag them back to study, and now a few oil tankers are not a problem. Currently, more than 30% of the world's crude oil is transported through the Strait of Hormuz. As a key location for crude oil transportation in the Middle East, once the blockade occurs, the consequences are bound to be a spike in oil prices that could once again hit the US crude oil market. This is expected to trigger a spike in inflation for the Federal Reserve, which has just announced that it will suspend interest rate hikes, and the US Treasury Secretary has warned of a looming debt default. This forces the Fed to continue to raise interest rates to curb inflation, but this in turn will add to the storm of the US banking crisis and the continued spike in the cost of the debt burden. Goldman Sachs analyst John Flood said that the situation of the US banking sector may further deteriorate. Short-term funds are shorting bank stocks in large numbers. The US banks of all sizes may be difficult to escape. So, from this perspective, this is equivalent to this action by Iran to put a financial nuke into the US financial system with precision. In addition, according to Zero Hedge, Saudi Arabia will convert some of its oil revenues sold to the Chinese market into gold instead of dollars and US debt. New information suggests that Saudi Arabia may trade and buy gold bars directly in yuan on the Shanghai Gold Exchange in the second half of 2023. In a report published on May 3, the Saudi Central Bank said the country is experimenting with digital currencies and has already launched a project with the UAE's central bank called Abbott to support cross-border payment systems and reduce transfer times and costs to bypass the US dollar. This suggests that the use of digital currencies in Middle Eastern countries may be accelerating, especially in the context of China's push to increase the volume and pricing power of the yuan in the oil and gold trade, potentially enhancing the influence and pricing power function of the oil yuan. The new development in the matter now is that the Export-Import Bank of China has signed its first RMB loan cooperation with the National Bank of Saudi Arabia, where Saudi Arabia's RMB funds borrowed from China will be prioritized to meet the funding needs under trade between China and Saudi Arabia, indicating that Saudi Arabia is officially borrowing money from China, according to the data, which shows that the National Bank of Saudi Arabia is the largest bank in Saudi Arabia, with total assets accounting for 29% of Saudi banking sector assets. This will continue to escalate Sino-Saudi economic cooperation to a new level against the backdrop of Saudi Arabia's recent repeated outflows to invest in Chinese companies, indicating that Saudi Arabia is turning to the Chinese market and will lay the foundation for cooperation when Saudi Arabia chooses the yuan over the dollar for energy trade with China, which is clearly a strategic move for Saudi Arabia to borrow money from China.